A variable rate mortgage is a home loan where the interest rate can change over time based on market conditions. Unlike a fixed rate loan, where your payment stays the same for 30 years, a variable rate mortgage adjusts periodically. Your rate is calculated by adding a lender's margin to a fluctuating market index, which dictates your interest cost. These loans often start with a lower rate than fixed options, but your monthly payments can rise if market interest rates increase. While fixed rates offer stability, variable rates offer flexibility that some investors use to manage short-term interest rate cycles. This chart shows how a rate might drift up or down year over year, directly impacting your monthly interest expense. Always read your loan document carefully to see if there is a ceiling on how high your rate can climb. Understanding your mortgage type is a vital part of homeownership. Check back soon for more basics on managing your money.